What are you seeing that is driving the current trend for private equity investment in law firms? Larry, let's start with you.
Thanks, Laura, and thanks for the introduction. From the investor side, law is really the biggest sector that has so far largely been untapped by the modern financial system, late capitalism, call it what you will. Um, I've said that it's the last unplucked turkey out there after private equity and other financialization sectors have uh, rolled up the medical sector, consulting, accounting, and many smaller parts of the economy. So I think the investor community looks at law and sees stable cash flows, significant margins, growing pricing power, and thinks, we can help rationalize that. From the firm side, I think the three big drivers are an increasing need, not just for capital, but for long-term capital, for slow capital, patient capital, in a way that's hard to reconcile with the classic law firm strategy of distributing cash and essentially not quite winding up every year. Firms are keeping more and more cash in-house, but nowhere near the amounts of capital that I think firms are starting to realize they're going to need in the new economy. A second reason is a real concern about retention and acquisition of talent. Again, law is weird, and we'll talk about that in a second, but the way law firms typically work, it's very difficult to keep the partners that you want to keep who have strong client relationships, except by giving them ever increasing amounts of cash. And that has some knock-on effects that have not been great. And I think it's increasingly a concern on the firm side. And the third reason is I think there's the dawning realization that they have an asset here, the equity in their law firms that has been largely untapped. Again, for reasons we'll talk about in a second. So the advent of outside investment, largely private equity investment to start, but it may not always be that, but outside investment in law firms creates the possibility of unlocking the value in law firm equity. Now, here's what I mean. If you take a step back, the legal sector is just plain weird. It's an all-cash economy. No firms have real boards of directors. They certainly don't have outside directors on their boards. Their equity, law firm equity, traditional law firm equity is really more like phantom equity in the sense that it gives you a claim on cash flow at best, claim on earnings, but it doesn't serve as a permanent store of value. You tend, at the end of your time with a firm, you tend to give it back to the firm and get the capital that you put in with little return or no return, regardless of whether the firm has grown and whether the equity value, if it were a normal business, whether the equity value would have increased. It's just weird. It's 100% employee owned. That's not a structure that you see in other large companies. Why did Lawland evolve like this? A lawyer would talk about ethical rules and the history of the profession and magic and how it's very different. As an elderly lapsed Marxist, I would say there are structural reasons for it. And I think maybe the better question is, why has it lasted so long? And I think the structural reasons are things like, historically, the legal sector has been capital light. You need a website in the modern world. You need some technology. You need some office space. Your employees and your attorneys tend to be variable expenses, not fixed expenses. It just doesn't require a lot of capital. And to the extent that you're taking on that you need outside money, you can get it in the form of bank loans for relatively low interest. And you haven't needed that much. For many years before the GFC, firms would run on their credit lines and make it all up by the end of the year, and it was all fine. Think Yertle the turtle at the beginning of the book. The turtles were happy. There was plenty to eat. The other cultural reasons why Lawland has persisted in being what I call weird, relatively low turnover at the partner level historically. low concentration by historical standards, by the standards of other businesses. It's a very fragmented industry. Major clients frequently had institutional relationships with the firms themselves. And then things changed. I date it to the GFC. I date it to the global financial crisis. I think a number of things happened after that, 2008, 2009 near-death experience for the economy. For many clients, everything was up for grabs. If they survived, they started taking a hard look at their counsel relationships, and it became possible to acquire clients that historically you'd have no shot at whatsoever, speaking from the law firm perspective. There was already a lateral market for partners. I think it increased. I think the elite firms, the elite law firms after the GFC and through the GFC adopted a strategy that many of us initially found confusing. They kept raising their rates, which had the effect of differentiating themselves, differentiating the 15 or 20 firms in the top 10 from the rest of the Am Law 100 forever and ever. And then, in addition to the conflicts, the clients being up for grabs, and the increasing lateral market for partner meant that partners were increasingly up for grabs. The third thing that has really changed is the increasing need for technology, and that's both defensive and offensive. To compete at the highest level, firms are going to increasingly need to spend more and more money on legal technology in general, and AI in particular. You will have seen the article about a week ago saying Kirkland is investing $500 million in AI technology. I'm not here to say how real that is or whether that's money that's well spent, but I am going to say that firms feel increasing pressure to make investments in technology. That's a long-term investment. That doesn't really fit well with a cash economy, which is what Lawland has historically had. So now, instead of capital light and largely stable sector, you have a capital intensive sector with a real retention issue, because you will have seen that partners increasingly are moving from firm A to firm B, and sometimes back then to firm A, with ever increasing pay packages. And given that it's a largely cash economy, that's extraordinarily expensive. Herb Stein, former chair of the Council of Economic Advisors, famously said, when something can't go on forever, it will stop. I think firms are increasingly realizing that and are much more interested in finding a new retention strategy, which real equity can provide, and building up balance sheets that are commensurate with the actual size of their enterprise, because they need the capital.
Fantastic. Thank you. Thank you for that. Dan, is there, from your perspective in your seat, anything you want to add to that?
Yeah, I think following on from Larry's summary, from a regulatory position, the UK was one of the first adopters of non-lawyer ownership to be permitted. That's been over a decade now. It takes some time. It takes some time for the market to recognize that. It takes time for the market to get comfortable with what is essentially a complex people business, which is what law firm is. And although in the UK it's been over a decade, we're only now starting to see a couple of examples where investors have invested into the industry and we've started to see a couple of exits as well. So that it takes a bit of time to build that conviction amongst investors. I think some of the points that Larry mentioned from investors' perspective is, they may have had success at other sort of professional service businesses, and so they therefore, rightly or wrongly, see law in the same opportunity. And now that certainly in the UK, there's a regulatory change in the permission to own law firms. Now you're seeing in the US this evolving structure with the MSO, which we'll touch upon shortly. But through the comfort of other transactions in other professional service businesses, that's helped people to understand it better. Law is also a classic example of has some of the ingredients that an investor likes, i.e., It's fragmented, it's a regulated business, and therefore barriers to entry. And although that it is a profession, there is also, I think, a recognition that for a number of law firms, there's genuine opportunity for further professionalization, if that's even a word, to bring further operational strength to a business. And like many generic questions, there's not just one reason. I think there's a multitude of factors as to why it's increasingly becoming more and more mainstream. I think it's the classic analogy is, the 10-year overnight success. And in the same vein, people have been talking about something for a while, something's been possible for a while, and it takes a certain tipping point for something to become all of a sudden much more mainstream. We're still at that tipping point. We're still at that early stage, and I think there's lots more to come in the years to come. But I think that a combination of factors as to why, in particular, now we're seeing more and more activity in this sector.
So what Dan is gently alluding to, very kindly alluding to, is the fact that some of us have been boring our friends with stories about how this was coming for well over a decade.
If you say the story long enough, it might come true. So.